Hello viewers, you're watching Dukascopy TV. I'm Natalie MacDonald. Up next in the studio, I've got Bjorn Martenson of Black Pearl Capital. Bjorn, thank you very much for popping back in again. Nice to see you.
Thank you for having me back.
So, in 2005, value-added investing was reported as gaining traction. Firstly, can you walk us through the development of this approach?
I think really, if you look at the performance of the markets in equities and fixed income since 2001, the real estate sector has been very well performing given its risk profile. And in the real estate sector, you had two classic investment strategies, which was just your core low risk, low return, steady real estate, and opportunistic real estate where really higher risks, new developments, emerging markets with higher returns. For value-added investing in real estate, there was a middle sector. And the middle sector that's developed is to say there are market inefficiencies that you can take advantage of, and these can get you greater returns with still low risk and low volatility.
Now, Black Pearl Capital employs this method by identifying assets with superior growth potential in global growth markets or distressed assets where intervention could add value. Where geographically or sector-wise have you seen opportunities with this?
Well, something specific again in the real estate space for us was in 2009 and 2010, there was still a big liquidity squeeze in the markets. We took advantage of this with some great investments in the UK and in the US. For example, in Nashville, we bought a shopping center, a little local one where there was no liquidity or cash available to give it the next renovation, make it look a bit nicer. We did some landscaping, and it was really pure, again, value-added investing. We therefore were able to increase the occupancy, and we sold the asset earlier this year with a great 36% IRR return, which given that amount of risk is really a very superior return.
What are the key identifiers then for companies with growth potential, and what kind of intervention can sometimes be required?
I think in general, we look at any opportunity or any company that has to have three significant things. The first is that it has to have a business proposition or a competitive advantage. You know, is there a market? Does it have superior products? What's the fundamental boring business of this company, right? The second one is people. It has to have great people. We're most of the time investing in people, and they're the make or break of this business proposition. And the third one is liquidity. Now, usually if the first two are very good and the third one is lacking, that's where our opportunities lie. If the third one is already available in the company, there's not that opportunity for us.
You touched already slightly on risk. If you're looking at potentially volatile markets for company investment, how do you balance that risk out? And similarly, is there a point at which a withdrawal of investment may be considered?
I think for us, we're so well spread, both geographically and sector-wise, that that provides a natural hedge for us within our fund and our investment strategy. But having said that, I mean, the market environment at the moment, I'm not a senior in terms of years, but it's such a difference in opinion at the moment of bulls versus bears, that the volatility is there in each of the individual investments, and they have their own fears and concerns. But from a bird's eye view, from a portfolio management standpoint, we're very happy that we've managed to cut out a lot of that volatility through spreading our investments in such diverse sectors.
Bjorn, thank you so much. Always a pleasure to receive you in the studio. Thank you.
Thank you very much.
That's all we've got time for right now, but for more exclusive interviews with market insiders, do stay tuned to Dukascopy TV. Goodbye for now.